Hi everyone, welcome back to my YouTube channel. This is your Manisha, and in today's video, we are going to solve short question from the risks and uncertainty topic of F5. I got a comment in one of my video that one of viewer has commented that they want a video on the payoff tables and time series analysis as well. So after completing this, I will go for time series analysis. So let's solve this question together. And these all questions are from the Kaplan exam kit. All right. So question number 118 and question is saying Shuffle company uses forklift truck in its warehouse. The management accountant is deciding which grade of truck to buy based on the risk appetite. There are three grades of trucks, A, B, and C series. Decision for the truck is dependent on the supple growth in its online market. Which could be 15, 30, 40% for the next period. The management accountant has correctly produced a payoff table showing the daily contribution on for each of the outcomes. So they have provided a table. See, the question number 118, 19, and 20, as well as 121. These all scenario are the same, only the requirement is the different. Okay, and this will really help to clear your doubt regarding the risk averse, risk seeking, and your regrettable one. Right, and one more thing, I do remember I have made one video on this topic where I have simplified that what is the other term for the risk averse which could be asked in your exam and which method to apply in this case. So there is video. You can find this video in the playlist name Simplified PM Topic. So you go to my channel and check those playlists. There you can find the video related to this topic. Right? Okay. So the requirement for this question is if Shuffle company is a risk averse, which grade of truck will it purchase? Enter the letter only. So in case of risk averse, first let's understand what is the risk averse. So it means someone or an organization that will prefer to avoid risks. They will always go for the safer option, no matter, even though that option will generate a lower return to the company, no matter. They will always choose a safer option because they don't want to take the risks. So this kind of person is no or organization is known as risk averse. And another name for this risk averse is pessimistic. The meaning is same, that also the pessimistic person always believe the bad thing will happens to him or her or the organization, and they often say that it won't work. They always look those half glass of water as a half empty, not as the full empty. So this kind of person or organization is known as a pessimistic, and the risk averse and pessimistic both are same. So don't get confused if in your exam say if the organization is pessimistic, don't get confused. They are saying that means it's a risk averse organization. So in that case, you need to apply maximin. You need to apply maximin. Now, in this method, you can see the word is saying maximin. That means you need to go for the minimum first, and out of those minimum, you need to choose maximum. Let's see how. See, we have the three options: series A, B, and C. Right? Series A, B, and C. And if we go for series A option, what is the minimum one value? Let me highlight. The minimum one is 1400. Right. So if we go for B, what is the minimum value? It's 1800. Right. So if we go for C, what is the minimum value? It's 3600. Right? 3600. So out of these three, what is the maximum value? So we go for minimum first. Then now, what is the maximum value? Maximum is 3600. So that means we will go for C series. All right. All right. So now next question. Now the question is asking if Shuffle company is a risk taking, which grade of truck will it purchase? Enter the letter only. Now the question said risk seeking, and the risk seeking means someone who are willing to take risks, no matter what will be the reward. Okay, so I mean, in expectation that they will hope for the better reward, but there is even a chance of higher failure, right? So this kind of person is also known as optimistic, and in this case, we will go for maximax. All right. Now in maximax, we will first look maximum, and out of those maximum, we will again go for maximum. So in series A, maximum value is 4900. In series B, maximum value is 2800. In series C, the maximum value is 4500. So out of this value, which one is the highest? 4900. So we will go with series A, and obviously the growth rate is 40%, which is the higher one, right? Okay, 120. So now 120 says, is Shuffle company adopt the Minimax regret approach to decision making? Which grade of stock will it purchase? Enter the letter only. See, now the question asks you to calculate the Minimax regret approach. In this case, we need to prepare the table, and I will show you how. So this one is table. I have copy pasted from the question. Okay, this one is copy pasted from the question. Now, it will basically, if we talk about this table, this payoff table or the minimax regret rule. So this strategy is the one that will minimize the maximum regret, right? So it is also known as the sore loser, that who does not want to make any wrong decision. And if we talk about the term regret, in this context, it means that the opportunity that we have lost, right, through making a wrong decision. Okay, so we need to calculate the regret first. How much regret will, I mean, value for all of these three series, and for calculating the regret, that means first we need to find the biggest payoff for each of the growth rate. Okay, so we need to find the biggest payoff for the each of the growth rate. So for 15%, what is the biggest number? It's 3600. Okay, for 15%, what is the biggest number? It's 3600. And if we go for the series A in 15%, that means 2400, right? So how much we lose? Just subtract 3600 minus 24, and that will give you 1200. We are done with this part. Now, if we will go for B series in 15% option, how much we lose? Again 1800. But if we choose C series in 15% growth, then we didn't lose anything. We didn't lose anything. Right. But now let's move toward the 30%. So if we have chosen the series A trucks that will give 30% growth, in that case, the value is 1400. But the maximum value in this growth is 4500. So how much we lose? 3100. But if we choose B series in 30% growth line, we will earn 1900. But how much we lose again? Because maximum is 4500. We lose 2600. But if we will choose C series in this line, no regret. Similarly, for the 40%, I have done. So now this is the regret table we have prepared. Now you have to choose maximum value for each of the series. For A series, maximum value is 3100, and for B series, maximum value is 2600, and the 4C series maximum value is 1000. And why we are going for maximum? Because it says minimax. That means we have to first choose the maximum one. Though out of those maximum one, we will go for minimum. And in our case, the minimum value among this is 1000. So that means we will go for option C. I mean series C. All right. Okay. Now 121. The question is same, but the requirement is different. Based upon the scenario information, if the probability of the given growth rate are 15% equal to 0.4, 30% 0.25, and 40% 0.35, Shuffle company is risk neutral. Which grade of stock will it purchase? Enter the letter only. So now in case of risk neutral, we will go for expected value. And for expected value, they will always provide the probability. And how can we figure out whether it's a probability or a simple percentage? So just add this probability figure. It should be equal to 1 or 100%. So if you add 0.4, 0.25, 0.35, it will equal to 1. So that means it's the probability. By using that, we need to calculate the expected value. So now what we have to do, we will go for the A series and multiply 2400 into the 15% probability, which is 0.4, and then for 1400 multiply by the probability of 30%, that's a 0.25, and 4900 multiply by probability of 40%, that's a 0.35, and then we will add all this. Here you can see here I have just taken the value 2400, multiply it by the probability, then taken 1400, multiply by the respective probability, and again last one 4900 multiply by its probability 0.35. Now you need to add all these and figure out, and you will get one number. Similarly for the B, I have taken this value and multiply by the expected probability, and similarly for the C1. So now add all these separately for series A, series B and C. Whichever the series will give the highest figure, just go with that. Okay? Okay. Now, question number 122. Which two of the following statement about sensitivity analysis are correct? Okay, the first one is saying, before reading the statement, let's understand what the this analysis is. So basically, this technique will help to figure out which one is the critical variable, right? Or which number or which assumption affects the result the most. Okay, so in business we make different kind of assumption, like what will be the selling price, how many we will sell, what will be the cost of those products. But this number can change in the real life. So this analysis basically check if we change one number, I mean like if we increase or decrease selling price, how much it will going to change in the result, like our profit, by how much percentage our profit will change, or whether we will make a loss. This analysis figure out this thing. It also has to find out which variable or input or number or factor is I mean assumption is more sensitivity, means like critical one. That means change, which one can change the decision if it is going to change by a little. Okay, so this is the all about the sensitivity analysis. And let's now read the statement. The first one is saying, sensitivity analysis can be used to gain insight into which assumption or variable in the situation are critical. Yes, as I said, so this analysis, this method will tell you which variable or which number affect the result most. As I said, like if there will be change in the selling price, by how much percentage our profit will change, or whether we are going to make or loss. So this is correct. Now, second one, sensitivity analysis gives useful information, provide information on the basis of which decision can be made, but it does not point to the correct decision directly. Again, it's true. So basically this method, this kind of technique will help you to understand the risks, but it does not tell you what to do, right? So again, it's up to the manager who will decide by themselves what to do. So again, this is correct. So if you will look at the option, as we know our option statement 1 is right. So by looking at the option, our option B is out, because it does not have a option 1. Again, option D is also out. So we have either A or C as our right answer. So again, we know second one is also correct. Then we obviously figure out our answer, that's A, right? But let's look the statement 3 and 4 as well to understand why it is wrong. Now, third one says, as well as identifying how far a variable needs to change, sensitivity analysis look at the probability of such change. No, this is done by expected value, right? So sensitivity analysis, it simply shows what happened if something is going to be changed, or if one variable is going to be changed, but it does not shows how likely it is. So it does not use probability. We use probability in case of expected value, right? So that's why it's incorrect. Now, fourth, sensitivity analysis not only assume that variable can change independently, it also allow to change more than one variable at a time. See, this is done by simulation, not by the sensitivity. So basically, in the this analysis, it usually assume its assumption is that only one variable will be changed at a time. But in reality, there could be more than one variable changing at a time, right? So that's why it's incorrect. Now we have question number 123. The question is saying indicate by clicking in the relevant box whether the following statement about simulation are true or not. All right. So before going to the statement, let's understand what it mean. I mean this technique. So basically, this one is a technique, or like it's a means of making a model based on the real life situation in a computer to see what could happen in the different strategy or different condition or different situation. Right. So, for example, if company wants to launch a new product and but they don't know what could be the like how much price to charge and what if the price will changes and how many people will buy, like what could be the response. So they use this technique to understand the different situation but on computer, right? It's like what could be the selling price, what could be the like cost if it increases, these all thing. So it's like a model of real life situation which will be performed in the computer, right? Now, first one is saying simulation models the behavior of system. Yes, this model creates. This technique creates a model, right? And how system works, like if any project or any machines. But it helps us to see how it behaves in the different situations, different conditions. So yes, it's a behavior of the system. True. Now, second one is simulation model can be used to study alternative solution to the problem. Again, it's true because it helps us to test different idea, different strategy to solve a problem, then compare which one is the best. Right. So yes, this is correct one again. Once again, then third one equation describing the operating characteristics of the system are known. This says we must know the exact formulas or maths for the how the system works, but it is not always true. In simulation, we randomly choose any number, or we often use estimates, not exact formula or equations, right? So that's why it's again incorrect. Then we have statement 4, that says simulation model cannot be prescribed what should be done about the problem. Yes, this model show you what might happen, but this does not figure out the right decision. At the last, it's up to the manager to decide. So it only helps you to understand the outcome situations in the different strategy. So that's why again it's true. Question number 124. A company has used expected value to evaluate one of the project. The expected value calculation assumed two possible profit outcome which were assigned probability of 0.4 and 0.6. Which two of the following statement about this approach are correct? The first one is saying expected value profit is the profit with the highest probability of being achieved. No, in expected value we used to take weighted average, not the outcome with the highest probability, right? That's why it's incorrect. Then we have a second one. Expected value gives no indication or dispersion of the possible outcome. Yes, in expected value, it will show average but not spread out the or exceed outcomes, right? So you need standard deviation or range to understand the dispersion of the possible outcome, right? So this is not indicated by the expected value. So yes, it's the correct one. Then we have expected value as relatively insensitive to the assumption about the probability. So it's again incorrect. Expected value is directly affected by the assigned probability. So change in probability will lead to a change in the expected value. Again, it's incorrect. And the last one is expected value may not correspond to any of the actual possible outcome. Yes, it's only a theoretical average. So it is not a real possible outcome, right? So your second and the fourth one is the correct. Now, question number 125. Tree company is considering employing a sales manager, and market research has shown that a good sales manager can increase profit by 30%, and average one by 20%, and poor one by 10%. Experience has shown that the company has attracted a good sales manager 35% of the time, average one 45% of the time, and the poor one 20% of the time. The company normal profit is 180,000 per annum, and the sales manager salary would be 40,000 per annum. Based on the expected value criterion, which of the following represent the correct advice which tree course should given? Okay. All right. For this kind of question, you need to make a decision tree like this I have prepared. So our decision is to employ sales manager, right? So currently they are having a profit of 180,000, right? So now there are three kinds of manager: good one, average one, and the poor one, right? So but the good one will increase the profit by 30%, and your poor one will average one will increase the profit by 20%, and poor one will increase the profit by 10%. But twist is here. What a twist is, so they have given the chance that according to the company experience, they have hired the good manager 35% of the time, average manager 45% of the time, and poor one 20% of the time. So now you guys might be confused whether this is expected value method approach or what. So as I said, yes, they have given the percentage, but you need to check it out whether it is equal to 1 or not. So if you will look at a chance, yes, these are probability which are given, because adding up all this equal to 100%. Okay, so it could be either equal to 1 or 100%. Now, we will calculate the profit, that if we will hire the good manager, by what amount our profit will increase. So if we will hire good manager, our profit will increase by 30%, which will be equal to 234,000. But if we will hire the average manager, our profit will increase by 20%. That means 180,000 into 1.2, that will give the profit of 260,000. And similarly for the poor, it will equal to 198,000. So now we will multiply this profit with the expected probability to in order to calculate the expected value. So multiply this two, I got 81,900, and multiplying this two, I got 97,200. Similarly for the poor manager, I got 39,600. Now add all this, we will get our expected value, which is equal to 218700. Now we need to deduct the salary portion of the manager, which is 40,000. So deducting this, it will give our expected value of expected profit of 178,700. You can look at previously our profit was 180,000, but after hiring the manager, we got decline in our profit by 1,300. So do you think you need to hire the manager? No. So obviously it could be the one, because profit would be expected to fall by 1,300. Now question number 126. Which of the following is the correct definition of imperfect information? The first one is information which cost more to collect than its value to the business. So basically more kind of related to the concept of information overload or diminishing returns from the information, not the imperfect one. Then next we have a information which is available only after preliminary decision on the business venture have been taken. So this is about the late information and its ability, not about its accuracy and the completeness, right? So basically imperfect information refer to the situation where whatever information we are having or available is incomplete, inaccurate, or uncertain, so which could be lead to the wrong decision or unreliable decision, right? So this could be the various reason like incorrect predictions, missing data, right? So that's why B is also incorrect. Now see, information which does not take into the account all factor affecting the business. So again, this is about the incomplete information but not the perfect information. So basically it refers to the like inaccurate information, uncertainty existed one, not incompleteness. And the last one, information which may contain inaccurate prediction. Yes, this is a correct description of the imperfect information, because it clearly explains that information may not be entirely be reliable, reflecting the uncertainty as well as inaccuracy. Then next we have question number 127. So company is considering developing a marketing of new product. Development cost will be 2 million. There is 75% probability that development effort will be successful and 25% of the probability that it will be unsuccessful. If development is successful and the product is marketed, it is estimated that the product very successful have a profit of this much and having probability this much, moderate successful this much and probability 0.4, and unsuccessful have a loss of 5 and probability 0.2. What is the expected value of the profit for the new product? So in this kind of question, you need to prepare the decision tree like this. You can see my screen. So our decision is to make a new product which cost is 2 million. But again, we have the two chances. Here question is saying there is two chances that product will be successful and unsuccessful. But if it is successful, there is 75% probability that it will be successful, and that means remaining 25% is unsuccessful one. Now, if it will be successful, again we have three options regarding that. Very successful, moderate successful, and your unsuccessful, right? So very successful have a profit of 6 million and moderate successful have a profit of 1.8, and unsuccessful have a loss of 5, and they have also provided probability for the each one. So I have just calculated the EV. This one is the profit, this one is the probability. So now I have calculated the expected value by adding all these value, right? That give me expected value of 2.12, but we again have a cost. Just a second, yeah. So we got our expected value of 2.12, but uh, we need to calculate expected value at each node. Let me show you the answer and then it will be more clear. Answer of the kit. So yeah, this diagram is perfect as comparison to mine one. So basically, these are the profit given. So at every node, we need to calculate the expected value. So here, this one is the probability given. So you need to multiply these two, right? Probability with the profit and then add all of this. Adding all of this will give you expected value of 2.12, so which I have calculated here. So at this node the value is 2.12, but we have again probability of 0.75. So 0.75 into 2.12 plus 0.25 into 0. Why? Because there is no any value attached to the failure one. So that's why 0, nil. So adding these two will give you the expected value of 1.59 at this node, but we don't have any now probability attached here. So now we will deduct the cost which is involved at the initial state, that's a 2 million, and then we will subtract this from this expected value, that will give the loss of 0.41. I hope you guys understand this. So I have shown the kit answer because the diagram was very perfect as comparison to mine one, so that's why I have shown the kit one answer. Now let's move to the question number 128. So in this question, the question is asking you, the company can make either two products, X and the Y, but not the both. The profitability of the each product depends on the state of the market as follow. So they have provided the profit for the both of these and the probability is also attached, right? Now, question is asking what is the expected value of profit information as to the state of the market. So basically, expected value of profit information is your formula is difference between the expected profit with the profit information and the best expected profit without profit information. So first, we need to calculate expected profit with the profit information and as well as best expected profit without profit information. Then we will calculate the difference of these two. Okay. So the market states goods, fair, and the poor, and the probability of the market is given is 0.2, 0.5, and 0.3. And for the product X, the profit is this one, and product Y, the profit is this much for the like each market state. So now let's calculate the expected profit for the X. And how can we do that? Just multiply 20,000 with the expected probability, right? 20,000 into 0. Let me write it down first. So expected value of product X, that's a 20,000 into what is the probability? 0.2, then plus 15,000, probability is 0.5, then plus 6,000 into 0.3. This gives us the expected value as 13,300. Now expected value of product Y, we have 17,000 into 0.2, 16,000 into 0.5, then we have 7,000 into 0.3. So altogether we have a value of 13,500. So now since the company will choose the product with the high expected profit. In our case, high expected profit is for the product Y. So whose expected profit is 13,500. So if we don't have any perfect information, so we will calculate the expected value and based on expected value, our value for the what is the question? So expected value without profit information will be 13,500, right? Now we will calculate expected value with the profit information, right? Now, if we have a profit information, so we will choose product X in the good market state, having the probability of 0.2, and in the fair market state, we will go with the product Y because having the higher profit, so multiply by 0.5, and again in the poor one, we will go with product Y because having a higher profit and the probability is 0.3. So now, expected value without perfect info equal to your 13,500 and expected value with perfect info equal to, so that's a 20,000 into 0.2 plus 16,000 into 0.5 plus 7,000 plus into 0.3. So this is the value of expected value with profit information. Now, question is asking expected value for the profit information. Right. Question is asking expected value with the profit and it will be difference of expected profit without profit information, expected profit with profit information. And the difference of these two will be your 600. All right. Okay. Now, question number 129, I will say to give a try from your end because we already have solved 2 or 3 questions of same kind. So just give a try from your end, and in case you didn't get, do let me know. I will try my best to solve it. Okay. Okay, now question is in question number 130, they are asking the expected value from investing in the product X, that is at the point D. So expected value at this point the question is asking. So question is an organization is considering launching a new product X. If product is successful in its first month, there will be an opportunity to either make a further investment or to outsource all future development to another company. This scene for the company is illustrated by the following decision tree. Okay. The profit outcomes do not include the cost of any investment made. Okay, so they have provided the decision tree ready-made. We don't need to draw it.